Are you investing or are you gambling? Depending on whether you're investing or gambling, it determines whether you're making money or losing money. Down the gurgler. If over time with your financial positions you are losing or have been losing money, then I'm sorry to say, you're gambling. If your aim is to make money, then gambling won't get you there without some seriously spooky unnatural luck. In this video, we will cover the importance of understanding if you're investing or gambling, how to tell if you're investing or gambling, how to minimize estimation risk when assessing if a position is a gamble or investment. So the definition of investing that we're using is the ability to wager where repeating the same wager produces a profit. Or as an official definition, put money into financial schemes, shares, property or commercial venture with the expectation of achieving a profit. The definition of gambling we're using is the ability to wager where repeating the same wager produces a loss. Insurance is therefore a gamble. You are essentially betting against yourself, usually with terrible odds. Why do people take out insurance then? To hedge. Insurance is a form of hedge. It's not a gamble to increase profits, but to reduce risk. If you have a house, you might not think of it this way, but for now consider this a large open position in the property market. There is a possible risk that it could burn down. You would do everything possible to stop your house burning down and losing your probable biggest investment. But you're only human, and therefore you purchase insurance to cover any failure you have to protect this massive exposure to risk. Home insurance is therefore a kind of hedge. When you know your investment in your house is safe, it gives you confidence to take other financial decisions. Hedging can make you more certain of an outcome. In the case of insurance, a financial outcome regardless of the status of the house. You can also hedge your share market investments in similar ways. We'll cover that in another video in the series. To cover what we've seen so far, some forms of gambling can be okay as a hedge, or if the intention is entertainment. But if this is not your intention, then you should look into how to invest. How do you know whether you're investing or gambling? Well, would you rather have a witch doctor treating you or a medical doctor? Most, I suspect, would choose a medical doctor. But what's the difference between the two? Science. In the same way you rather have science involved in medicine, you should have science involved in finance. So we want to treat investment as a science rather than a superstition or quackery. Hopefully that will cause your returns to be more healthy as a result. Statistics can help us here. Statistics allow us to translate every investment into a standardized number. That number is called expected value and can be used to compare shares. The method is as follows. You should do a mental calculation or a spreadsheet every time you invest. Work out the various different scenarios, then work out the percentage chance of getting each of these possible scenarios. You then multiply each of the scenarios' chance by the expected profit or loss for the scenario. The total result is your expected value. Here are 3 examples. In the table, from top to bottom, we have the scenario name on top, the chance of investment going to 0, the chance of doubling, and the expected value, which is the result we need. Looking at the first scenario, A, there's a 50% chance of doubling or losing your money. This is a fair game, but statistically you're no better off, giving an expected value of 1. In fact, you lose the time and effort playing it, so it's just dumb. Scenario B, there's a 75% chance of losing your money and 25% chance of doubling it, with an expected value of 0.5. This is a proper gamble, so you would normally prefer scenario C, where there is a 75% chance of doubling your money and a 25% chance of losing it, meaning you have an expected value of 1.5. This is an investment. Now that's only a simple scenario to demonstrate the difference between an investment and gambling, but there is a whole spectrum of other scenarios and other different types of risks, such as chance of going bust, chance of going down, chance of being a zombie company, chance of pottering along, chance of just rising slowly, chance of doubling, chance of more than doubling, chance of being taken over, etc., etc. And then there's different types of risks, like diversification risk, quantification risk, etc., etc. Remember we mentioned hedging a short a while ago. Hedging can make an outcome guaranteed to happen. This will help simplify your model so you don't have to worry about every potential scenario. So we won't cover too much on minimizing risk, but you do need to be aware of estimation risk. Using the simple expected value model above, we can be prone to estimation risk. This is where we get expected profits wrong, or we get the expected chance of getting the profits wrong, and hence the wrong expected value. To reduce estimation risk, we need to understand what we do know and don't. Information about a stock is either available or unavailable. The left-hand side of the image shows a situation where we have gaps in what is available but don't know. On the right side, what happens when we fill those gaps of information available and we do know it. When we fill those gaps, we may actually find some of the things we thought were unknowable actually are knowable. Or there is more that we realize we need to know. The further we can move from the model on the left to the model on the right, the more confident we can be in our estimation of our model, the less risk we will have. To get the model on the right, we just need time, effort, and skill. Or in the absence of this, you need to reduce your expected value from your calculations to take into account the variables you're missing and the reduced certainty this offers. Being on the left side will put you one of the following: the naive, the uneducated, the risk takers, or the gamblers. Being on the right side will put you one of the following: the insiders, the geniuses, the manipulators, and the professionals. Money over time should normally move from the players on the left to the players on the right. The players on the right have information asymmetry. It's major league versus minor league. If, like me, you're only a part-time investor, then you're up against a whole ecosystem in the investing world and don't have the time to get fully on the right-hand side. So there is a chance you could end up on the left-hand side. One strategy is to move yourself over to the right by focusing on just one sector, whether that's retail clothing, supermarkets, construction, banking, or whatever. By concentrating your efforts, you may stand a chance. When you understand who the probable winners and losers are of that sector, and you can better compete against the big boys. With additional tools, you can even make money on the share, even when the whole market or sector goes down. At a bare minimum, you should read the financial reports, read and listen to the accompanying meetings, presentations, and statements, then verify your knowledge by discussing your findings on a shared chat board. Anything less is not being properly informed, and potentially a form of gambling. The more speculative you are, the less confident you can be in your model. The more unknowns there are, the more you should reduce the expected value in your calculations to compensate. Housekeeping. The author will not be held liable for any errors or content in this video whatsoever. You're responsible for your own verification of facts. This video is only intended to educate and not be taken as investment advice. I'm not a qualified financial advisor. Please do your own research or consult your own financial advisor. Good luck.